Hey everyone, this is Mayhem talking markets. I'm doing this video on behalf of Barchart.com. We're going to talk a little bit about options and in particular quad witching that's coming up. But first, I wanted to just take a moment to look at some of the unusual options activity that we've been seeing in the market. So here we are on Barchart.com. And I like this website because they have a lot of resources that you don't find elsewhere, and they're all put under pretty easy to navigate links. So I do like to look at the options market here. In particular, I like to look at unusual options activity. Since we're coming up on quad witching, we do see a lot of rotational flows. People are moving from March to later expirations, either later in March or in later months for a lot, but not all of the activity we see. We're going to focus on the top 10, and we're going to look at that based on volume. So today we saw more put buying than call buying in our top 10 here, and that was about 6-4 when it comes to puts being bought versus calls being bought. Most of these were at expiration dates that are pretty close by. So some of these are actually expiring this week, so these are probably not rotational. These might be just very aggressive positions for these calls looking at 4,300, or perhaps they were actually covering sold calls. We don't really know, since we don't know the full positioning, everything that's going on, but we can at least make some inferences about how it affects liquidity in the market. And so the put buys are pulling liquidity out of the market, the call buys are adding liquidity to the market, and so that's something to keep an eye on. And it was also interesting to see puts bought with such low strikes, 2150, 3500. That's a pretty aggressive strike for April 14th. So something to think about. And we don't know the other legs of the trade, so we can't make an inference as to whether it's a bullish, bearish, or neutral bet, but we can at least take a look at how it impacts markets through how dealers would hedge for this positioning. So this is an interesting resource. It's right there available on Barchart.com under their options tab. You can look at unusual options activity, and you can actually look at it through various ways. So you don't necessarily have to look at it based on volume. You could look at volume versus open interest. You could look at implied volatility. You can look at it from a number of different vantage points that can be constructive to how you're researching it. So, like for example, if we sort it based on volume versus open interest, that can give you some more signs as to where there's a lot of unusual demand happening. And again, a lot of it is within puts, so that's something that I think remains interesting, that you still see some potential hedging flows going on even post FOMC, and also some rotations of those hedges perhaps to later months in some of these trades. So it's something to keep an eye on, and it's worth checking back on this resource on a daily basis, typically towards the close, so you can get a sense as to what the unusual options activity that day was. Especially interesting as well to see the implied volatility on some of these options be as high as they are. I think that's very interesting. A lot of it's front loaded when you look at the term structure. You see more of that implied volatility in March, in April, in May and June contracts, and it really starts to drop off pretty precipitously. Similarly true, we see the VIX in backwardation, and as you go through some of those later months, it really starts to fall off pretty precipitously. So all related to a lot of angst, a lot of consternation, a lot of volatility, and a premium to be paid to get involved with that in the here and now. As we get into the SPX, which is the most commonly traded options by quite a lot, we're looking at an SPX index that has crossed into positive gamma territory, which means that now dips are being bought and rips are being sold. So if the S&P 500 is to move up 1%, you basically see about $12.8 billion of selling pressure. If the S&P 500 is going to move down 1%, you see about $12.68 billion worth of buying pressure. You also see open interest concentrated at 4,300, 4,350, and 4,400. So those areas are important to watch because they can have a little bit of a magnetic or gravitational effect. That is to say, they can act as support, they can act as resistance, but they can also just sort of pull prices to those levels as a liquidity magnet. So I would be watching very carefully 4,300 as a potential support area, 4,350 as a potential area of resistance based on the levels we are right now, which is Thursday after close, and then 4,400 as another potential area of resistance, just based on this positioning, which again is going to change after Friday. When we're looking at the gamma exposure profile, the gamma flip level has been calculated based on scraping about 10,000 options traded on CBOE for SPX at 43.06, so that means we're above that level. It means we're currently in positive gamma territory, which again means dips are bought, rips are sold. It compresses volatility a little bit. We're just coming out of a negative gamma regime, which is where you see dips basically being sold, rips being bought, and that exacerbates volatility. So we are moving from a more leptokurtic regime to a less leptokurtic regime. That means it does compress some of that fat tail risk a little bit, but that's also going to be more pronounced as we get closer to the end of the month and we start to see those passive flows like Vanna come back online. Right now, she's essentially out of town. When we look at the options expiration this Friday, which is a quad witching, which means you have multiple products expiring, not just options, but futures and other types of contracts. So you have options for equities, options for ETFs, options for indexes, and options for futures. Those are all going to be expiring with a total notional value of $3.3 trillion on March 18th. That is, again, this Friday, with an AM settlement of about $2.1 trillion. Most of that is with SPX. So you can see just how enormous SPX is as a part of the options market. And all the related SPX options are over $2 trillion, the ones that are all connected to it. So that's the biggest component. That's over 2/3 really of this total notional gamma expiration. So I think that's important to take into consideration because a lot of this is going to be rotated, and a lot of that rotation is happening this week where people are moving their positions from March to April and beyond. So it can cause some volatility. It can change some of the dynamics in the market, especially on Friday. Something to keep an eye on because a lot of these options expiration events and especially quad witchings tend to bring about a greater amount of volatility than we normally see, and the market is already quite volatile, and often is the case it leads to a further drawdown, although not always, but often is the case that options expiration Friday and the Monday that follows can lead to some downward pressure. When we're looking at the options expiration and we're just breaking it down by index and index ETF options, we can see that SPX is by far the largest expiration. But we can also see that the total exposure in these really breaks it down, really gives you a sense of just how big they are. For SPX right now, totally across the board, across some almost 10,000 options chain, there's $6.7 trillion of notional open interest. That's incredible, quite frankly. That's a lot of money tied up in that, especially when you compare it to RTY, IWM, QQQ, or NDX. It's not even close. So when you look at these various vehicles for options exposure, SPX is the creme de la creme. Everyone is using that as their premier hedging vehicle. The options in SPX are extremely liquid, and you can see when you look at the expirations that the majority of that open interest is really rolling off this Friday. When you look at SPY, it's a different picture. Most of the open interest is coming off between last week and this week, but it's not nearly as front-loaded as we see with SPX. So this is a different picture right here. It's a different picture in IWM. It's a different picture in RTY. It's just not nearly the same level of open interest coming off in these other options as there is in the SPX. So I think that's worth watching because I think it should potentially cause more volatility SPX and SPX linked products as we get into Friday, since we see just such a large amount of open interest expiring, or at least potentially being rolled forward. When we look at implied and realized volatility, what we're seeing is that we haven't seen, and we talked about this a little bit in the bar chart page, we haven't seen this kind of volatility since 2020. And that's really important because it suggests that the market is in a place where there is more demand for volatility products. There's also more demand for hedging vehicles, but there's also less liquidity. And that lack of liquidity leads to wider price ranges, which leads to wider implied and realized volatility as well. Whereas, if something is moving much more, then a market maker, to protect themselves from risk, is going to assign a higher premium to getting involved with that product. And then that way it's a little bit safer for them to be selling contracts, and it gives them a little more breathing room to be doing the hedging on the same side of that. So I think it's important to realize that this level of volatility is high enough that it's concerning. It's high enough because it means that prices can move, at the SPX level, 2% or at least close to that on a daily basis. When we look at index and ETF notional option volume, what we see is that institutional participation, which is usually on the index side, is on the rise. It's about $1.3 trillion per day of options traded at the index levels. You can see there's a lot of participation, mostly on the put side. Most of the skew goes towards puts on the index level. So when you look at a volatility surface, you can see that most of the premium paid is being paid for puts, and that's because institutions are hedging value at risk, and they're trying to reduce value at risk. They're hedging their portfolios, and so you can see that that's part of what is driving some of this increased participation, is that as the price of the S&P 500 rises and as institutional participation has been increasing, there's more demand for hedging products. You can also see, however, on single stock options, there's been a record growth of participation there, and a lot of that, though not all of it, has to do with retail. And retail tends to be buyers of call premium on the equity side and sellers of put premium on the equity side. And we've seen a couple records. We saw a record in February and we saw a record in November, and both of those records represented times of peak euphoria for retail, where they got way too excited about what was happening in the some of the favorite stocks, got very, very long with leverage, buying calls, selling puts against these same companies, and those marked short-term tops in some of these components, even longer-term tops. Just basically, when you had that level of options-driven participation, it drove irrational price discovery to the upside until it kind of blew out. And then as soon as those flows weren't happening, the path of least resistance was for market makers to then begin selling off those same positions they had took on their book to hedge. So this is something that is worth watching as to whether or not we see this activity continue to ratchet higher, especially in an environment of tightening liquidity conditions. Why is it important? I would also note that because options are essentially shorter duration, larger leverage, that they tend to drive greater price movement in their underlying instruments, especially in single stocks. But index options can't be ignored either, especially with this level of participation. So I think it's important to just keep an eye on how much participation there is with index options, because it demonstrates to us as market participants that there is greater leverage in the system, and therefore there's greater risk of these sort of left and right fat tail events, which means larger than normal price movements. When we look at liquidity, liquidity is deteriorating in the equity market, and this is a problem because it's leading to greater and greater swings in price, and it just doesn't take nearly as much volume to swing up the price in a greater way. And the other problem with that is that a lot of that volume is coming in on the option side, which is implied leverage. So you have more and more impact with less and less volume. So this is a market where it doesn't take a lot to move it a lot, and we've seen that. It's been really a core theme of 2022, I feel like. We also see that single stock option is less call heavy than usual for 2022 so far, which is probably a little bit of an encouraging sign. That is just to say that maybe some of the euphoria is starting to wear out. Maybe some of the buy the dip mentality in options is starting to wear out a little bit. We're kind of starting to get back to some of the levels we saw pre-COVID. You can see that during the post-COVID correction period, there was just a very, very high level where calls were up to 70 or 65% of all volume, and that's just not normal. That represents way, way, way too much optimism to a point of being euphoria. We can see here that there's really not a lot of liquidity in the SPX futures market. So I see this because I trade ES almost every day. And I have seen how the liquidity picture has changed a lot on the order book. There's just less resting liquidity and less actively participating liquidity on a daily basis. And you can see it in the spread sometimes, but you can also see it in the order book. I like to look at Bookmap to visualize that flow. I also like to look at volume profile, and you can see it in a number of different places where it's just the market feels like there's just a little bit of hollowness to it. There's not the same level of activity, of participation. It's like some participants are just sitting on their hands. And that, again, exacerbates this volatility. It adds to the larger tail risk, the fat tail risk that we see both left and right. It's what Jem Carson has described as a leptokurtic distribution of fat tail risk, which is, again, where you have more leverage, less liquidity, greater price movements, and therefore it makes sense to be very careful managing risk, and sometimes that means smaller position sizes make the most sense. We can also see the Goldman Sachs Global Financial Conditions Index is showing tightening. Tightening also has the effect of pulling liquidity out of markets. So we can see there's a number of different metrics that are giving us the idea that there's greater leverage in terms of participation, but also tighter financial conditions and less liquidity. So this is a picture that I think is important to paint as we move forward, because it shows that the market is in a place where it's similar to other end cycle environments where, if there is a really big negative catalyst, the market can go down precipitously. But on the other side of it, if there is a big positive catalyst, like let's say there is a real ceasefire and peace agreement between Ukraine and Russia, the market could really, really rip. You could see a 3 or 4% up day on some kind of constructive catalyst, just like if the Fed became actually dovish. I think that would be a pretty big catalyst. I'm not saying that's to come anytime soon, but at some point it will. And when it does, if we're in the same kind of environment or worse in terms of liquidity, it will have an outsized positive effect. And the last chart that I wanted to show as a part of this video is just demonstrating that liquidity is strongly negatively correlated with volatility. So that means when you have a strong abundance of liquidity, when you have a lot of participation in financial markets, you have lower volatility, right? Where there's more volume, there's less volatility. But when there's less liquidity, when there's less orders in the order book, when there's less futures depth, as the chart says, you see higher levels of volatility. Well, what did we just discuss? We just discussed that there's less participation in ES and SPX. There's less in the order book, so there are greater levels of volatility. And unless and until that changes, this new leptokurtic distribution of fat tail risk, this higher volatility environment, is the market regime that we can expect to have to deal with for much of this year, if not the entirety of this year. And pivots from that, I think, would be less participation in the options market, more volume in the stock market, and more accommodation from central banks, who are really the premier providers of liquidity for this 13-year bull market. So I want to thank everyone for tuning in. I hope this has been informative. I do want to be mindful of everyone's time, and I know that about a 20-minute video is about the sweet spot. So I'm Mayhem. You can follow me on Twitter, Mayhem for Markets. You can check out my website, marketsandmayhem.com. I'm also the co-founder of TraderAid. We are a service that helps traders and investors become more consistent. We provide educational tools, research, trade ideas. We also have hands-on coaching and courses about day trading and exclusive interviews that we provide with professionals and retail investors and traders and other people that have thoughts that we think add to the discourse. So I want to thank you for tuning in. I also want to thank Thomas at Barchart for the opportunity to do this video, and hope you all enjoyed it and learned something, and look forward to seeing you again soon.